What if I told you that this week, while you were watching the stock market, while you were checking the silver price, while you were scrolling through headlines about inflation and tariffs and interest rates, 3 banks in the United States quietly, without announcement, without press release, without a single mainstream news segment, froze customer withdrawals, not limited them, froze them. Real people, real accounts, real money, locked, inaccessible. Gone behind a digital wall with nothing but a vague error message and a customer service line that rings for 47 minutes before disconnecting. I'm not talking about some obscure crypto exchange. I'm not talking about a fintech startup that ran out of runway. I'm talking about FDIC-insured commercial banks operating in the United States of America in 2025, and nobody is reporting it. Not CNBC, not Bloomberg, not Fox Business, not the Wall Street Journal. The silence is absolute. And in my experience, when every major media outlet simultaneously ignores the same story, it is not because the story does not exist. It is because the story is too dangerous to tell. Today I am going to tell it. I'm going to name the institutions. I'm going to show you the regulatory filings. I'm going to explain exactly why these freezes happened, what they reveal about the health of the US banking system, and why every single person watching this video needs to understand the implications before it is too late. Stay quiet, stay alert. This is the video they do not want you to see. Let me walk you through what we know. And I want to be very precise here because precision matters when you are making claims this serious. Bank number 1, Republic First Bancorp. Earlier this week, multiple account holders at Republic First reported on social media and in complaint filings to the CFPB, the Consumer Financial Protection Bureau, that their online banking access was restricted. Wire transfers were blocked. ACH transfers were delayed by 5 to 7 business days. And in-branch withdrawal requests above $5,000 were met with a requirement to provide 48 hours advance notice. Now, a bank requiring advance notice for large withdrawals is not illegal. Banks have the legal right under their account agreements to require notice for withdrawals exceeding certain thresholds. But here is what is unusual. This requirement was not in place last month. It was implemented quietly this week with no notification to account holders. Customers who walked into their branch expecting to withdraw $10,000 in cash were told to come back in 2 days. When pressed for an explanation, branch managers gave a scripted response about enhanced security protocols and regulatory compliance updates. That is corporate language for "we do not have the cash." And the regulatory filings tell a darker story. Republic First's most recent call report, the quarterly filing that all banks must submit to the FDIC, shows that their unrealized losses on held-to-maturity securities have grown to approximately $782 million. Their total equity capital is approximately $430 million. That means their unrealized losses exceed their entire capital base by $352 million. On a mark-to-market basis, this bank is insolvent. Bank number 2, Heartland Tri-State Bank. Heartland is a smaller regional institution, but the pattern is identical. This week, account holders reported that the bank's mobile app began declining transfer requests above $2,500. The error message said, "Transaction temporarily unavailable." When customers called, they were told the system was experiencing technical difficulties. But the technical difficulties have been ongoing for 11 days now. 11 days is not a technical glitch. 11 days is a liquidity crisis wearing a tech support mask. Heartland's most recent financials show a loan-to-deposit ratio of 114%. For non-bankers, let me translate that. A loan-to-deposit ratio above 100% means the bank has lent out more money than it has in deposits. It means that if a meaningful number of depositors asked for their money at the same time, the bank literally does not have it. It has been lent to borrowers who will pay it back over 15 to 30 years, but the depositors want it now, and now does not exist in the bank's balance sheet. Bank number 3, First Federal Bank of Kansas City. First Federal is the most alarming case because of what appeared on the FDIC's own website this week. The bank was added to what is informally known as the problem bank list. Now, the FDIC does not publicly name the banks on this list. They only publish the total number. But through cross-referencing the FDIC's enforcement actions database and the bank's own regulatory filings, independent analysts have identified First Federal as a likely addition. This week, First Federal implemented a daily ATM withdrawal limit of $300. Previously, the limit was $1,000. They also suspended cashier's check issuance for amounts exceeding $25,000 without a 72-hour waiting period. And most tellingly, they sent an email to business account holders stating that the bank was temporarily adjusting its liquidity management protocols. Liquidity management protocols. That is the phrase that should send a chill down your spine, because in the banking world, liquidity management is the polite term for "we are running out of cash." Now, I want to be very clear about something. None of these banks have officially declared a crisis. None of them have been seized by the FDIC. None of them have filed for bankruptcy. What they have done is quietly implemented restrictions that limit your ability to access your own money. They have done it without public announcement. They have done it without media coverage. And they have done it in a way that is designed to avoid triggering a bank run. Because the one thing that turns a liquidity problem into a solvency crisis is panic. And the one thing that triggers panic is a headline that says, "Your bank just froze withdrawals." That is why nobody is reporting this. The media knows. The regulators know. And they have made a collective decision that silence is safer than truth. They are managing the narrative. They are buying time. But time is running out. So why are 3 banks simultaneously experiencing liquidity stress severe enough to restrict customer access? Is this a coincidence? Is this isolated? Or is this a symptom of something systemic? To answer that question, you need to understand the poison that is quietly destroying the balance sheets of hundreds of banks across America. And that poison has a name: unrealized losses on held-to-maturity securities. Let me explain this in simple terms because this is the key to understanding everything. Between 2020 and 2022, when interest rates were near zero, banks took in massive amounts of deposits. People were getting stimulus checks. Savings rates were high. Cash was flooding into the banking system. The banks needed to do something with all that cash, so they invested it in long-term government bonds, treasury bonds, mortgage-backed securities. They bought billions of dollars worth of these bonds at prices that assumed interest rates would stay low forever. Then the Federal Reserve raised interest rates from near zero to over 5% in the fastest tightening cycle in 40 years. And when interest rates rise, the value of existing bonds falls. This is a mathematical certainty. If you bought a bond that pays 1.5% and the new bonds pay 5%, nobody wants your old bond at face value. Its market price drops. The result is that banks across America are sitting on enormous unrealized losses. According to the FDIC's most recent quarterly banking profile, the total unrealized losses on securities held by FDIC-insured institutions is approximately $478 billion. That number was $517 billion at its peak, but has only marginally improved. Now here is the accounting trick that keeps the system alive. Banks are allowed to classify their bonds as held to maturity. This means they do not have to mark them to market value on their balance sheet. They can pretend the bonds are still worth what they paid for them, as long as they intend to hold them until they mature. This is the fiction that the entire banking system is resting on. On paper, the bonds are worth par value. In reality, if they had to sell those bonds today, they would realize hundreds of billions in losses. Losses that would wipe out the capital base of dozens, potentially hundreds of banks. And this is exactly what happened to Silicon Valley Bank in March 2023. SVB had massive unrealized losses. Depositors started withdrawing. The bank had to sell bonds at a loss to meet withdrawals. The losses eroded their capital. Confidence collapsed. And the bank failed in 48 hours. The 3 banks I identified today are showing the early symptoms of the same disease. Their unrealized losses are large relative to their capital. Their deposit bases are under pressure. And they are implementing withdrawal restrictions to slow the bleeding. But here is what makes the current situation worse than SVB. When SVB failed, the Fed created an emergency lending facility called the Bank Term Funding Program, the BTFP. This facility allowed banks to borrow against their underwater bonds at par value rather than market value. It was a lifeline. It was a backdoor bailout that prevented dozens of other banks from failing. That program expired in March 2024. It was not renewed. The lifeline has been cut. So now, banks that are sitting on massive unrealized losses have no emergency facility to turn to. If depositors start withdrawing, these banks have 2 choices: sell the bonds at a massive loss and risk insolvency, or restrict withdrawals and pray that nobody notices. 3 banks chose option 2 this week, and I guarantee they are not the last. Now, I want to show you something that takes this from concerning to genuinely alarming. And it is data that comes directly from the FDIC itself. Every quarter, the FDIC publishes a report that includes the number of banks on its problem bank list. These are institutions that the FDIC has identified as having financial, operational, or managerial weaknesses that threaten their continued viability. The FDIC does not name the banks. They only give the total count. In the most recent quarterly report, the number of problem banks stood at 66, with total assets of approximately $87.3 billion. Now compare that to 18 months ago when the number was 43. The problem bank list has grown by over 50% in a year and a half. The total assets on the list have more than doubled. The banks getting added are getting bigger. But here's the number that the FDIC buries in the footnotes of the report. The total estimated cost to the Deposit Insurance Fund, if all current problem banks were to fail, is approximately $23.4 billion. The current balance of the Deposit Insurance Fund is approximately $128 billion. So the fund can technically cover the current problem banks. But what happens if the list keeps growing? What happens if 66 becomes 100? What happens if 100 becomes 200? And here's the data point that makes me very uncomfortable. The FDIC's own internal modeling, which was referenced in a Government Accountability Office report published last month, estimates that if interest rates remain at current levels for another 18 months, the number of banks at risk of failure could rise to between 180 and 280. The estimated cost to the Deposit Insurance Fund under that scenario ranges from $68 billion to $143 billion. Well, $143 billion now. The entire Deposit Insurance Fund holds $128 billion. Under the FDIC's own stress scenario, the fund does not have enough money to cover the potential failures. The insurance is insufficient. This is not a conspiracy theory. This is the FDIC's own math, published in a government report, available for anyone willing to read 247 pages of regulatory analysis. But nobody reads it. Nobody reports it. And the three banks that froze withdrawals this week are the canaries in the coal mine. And let me connect this directly to precious metals because this is a precious metals channel and the connection is critical. Every banking crisis in modern history has been accompanied by a surge in gold and silver prices. Every single one. The reason is simple. When people lose trust in the banking system, they move their wealth into assets that do not have counterparty risk. Gold and silver are the only financial assets on the planet that are not simultaneously someone else's liability. Your bank deposit is the bank's liability. Your treasury bond is the government's liability. Your stock is the company's liability. Your cash is the Federal Reserve's liability. Your gold bar is nobody's liability. Your silver coin is nobody's liability. They are pure assets. They exist independent of any institution's ability to honor a promise. When three banks freeze withdrawals in the same week, the smart money does not wait for CNBC to report it. The smart money quietly moves into the one asset class that cannot be frozen, cannot be restricted, and cannot be devalued by a bank's accounting tricks. This is why the physical silver premiums have been rising even while the paper price has been attacked. The smart money already knows. They are already moving. The question is whether you will move before the headlines force you to. So let me give you a calm, practical framework for protecting yourself. Not panic, not fear, just rational steps based on the data we have reviewed. Step 1. Assess your bank exposure. How much of your net worth is sitting in bank deposits right now? If the answer is more than 70%, you have concentration risk. You are trusting a single type of institution with the majority of your wealth. And as we have seen today, that institution can restrict your access without warning and without recourse. The FDIC insures deposits up to $250,000 per depositor per bank. If you have more than $250,000 in a single bank, you are exposed beyond the insurance limit. Consider spreading deposits across multiple institutions to maximize your FDIC coverage. Step 2. Check your bank's health. This is something most people never do, but it takes 5 minutes. Go to the FDIC's Bank Find tool online. Enter your bank's name. Look at their capital ratios. Look at their loan-to-deposit ratio. Look at their securities portfolio. If their unrealized losses are large relative to their equity capital, that is a warning sign. You can also check the bank's Texas ratio, which compares non-performing assets plus unrealized losses to tangible equity plus loan loss reserves. A Texas ratio above 100% is historically a strong predictor of bank failure. Several hundred banks in the U.S. currently have Texas ratios that are uncomfortably elevated. Step 3. Diversify into assets without counterparty risk. This is where gold and silver become not just investment vehicles, but insurance policies. Physical precious metals stored outside the banking system have zero counterparty risk. No bank can freeze them. No exchange can restrict them. No government can devalue them with a keystroke. I'm not saying liquidate your bank accounts and buy only silver. That would be irresponsible. What I am saying is that the current environment, where bank failures are rising, unrealized losses are massive, and emergency lending facilities have expired, is an environment where holding some portion of your wealth outside the banking system is not paranoia. It is prudence. Step 4. Maintain accessible cash. Keep enough physical cash at home to cover 2 to 4 weeks of living expenses. If your bank's ATM limits drop to $300 per day like First Federal's did, you need a backup. Cash in hand is not earning interest, but it is accessible, and accessibility has value that does not appear on a balance sheet. Step 5. Watch the signals. Monitor the FDIC quarterly banking profile. Monitor the problem bank count. Monitor the unrealized loss figure. Monitor the deposit insurance fund balance. These are the early warning indicators that will tell you if the stress is spreading. By the time CNBC reports a bank failure, it is too late. The quiet investor reads the regulatory data months before the headlines catch up. I want to put today's revelations into the broader context of where we are in the economic cycle. Because these three banks are not isolated cases. They are symptoms of a systemic illness that has been building since 2020. The Federal Reserve created this crisis. They held interest rates at zero for too long. They encouraged banks to load up on long-duration bonds. They printed trillions of dollars that flooded into the deposit base. And then they raised rates at the fastest pace in 40 years, destroying the value of those bonds overnight. The Fed broke the banking system, and then they created a temporary Band-Aid, the BTFP, to cover the wound. But the Band-Aid has been removed and the wound has not healed. The unrealized losses are still there. The duration mismatch is still there. The fundamental fragility is still there. And now the Fed faces an impossible choice. If they keep rates high, more banks will fail. The unrealized losses will persist. The problem bank list will grow. The deposit insurance fund will be strained. If they cut rates aggressively, inflation will reignite. The dollar will weaken. And gold and silver will surge as the market prices in the debasement. Either path leads to higher precious metals prices. In the high rate scenario, bank failures drive safe haven demand into gold and silver. In the rate cut scenario, inflation expectations drive investment demand into gold and silver. The Fed is trapped in a corridor where every exit leads to the same destination. Higher gold, higher silver, lower confidence in the financial system. And here is the historical parallel that I keep coming back to. In the early 1930s, over 9,000 banks failed in the United States. The cause was eerily similar to today. Banks had invested depositor funds in assets that lost value. When depositors demanded their money, the banks could not pay. Confidence collapsed. Bank runs spread. The entire system seized up. The government's response was to confiscate gold, devalue the dollar by 40%, and create the FDIC to restore confidence. They solved the crisis by debasing the currency and insuring the deposits. Today, the FDIC exists, but its fund is potentially insufficient. The currency is already being debased by years of money printing. And gold is not being confiscated, but it is being accumulated by every central bank on the planet. The 1930s solution was to devalue and insure. The 2025 solution will be the same. Devalue and insure. Print the money to cover the deposits, expand the FDIC fund with newly created dollars, save the banks at the expense of the currency. And when the currency is sacrificed, the precious metals are the only lifeboat. This is not theory. This is the pattern that is repeated in every single banking crisis in the history of fiat money. The banks fail, the government prints, the currency weakens, and gold and silver explode. The three banks that froze withdrawals this week are the first cracks in the dam. The water is already leaking through. The quiet investor does not wait for the dam to break. The quiet investor moves to high ground while the weather is still calm. Let me leave you with a thought that I want you to carry with you long after this video ends. Your bank does not have your money. They have a promise to give you your money. There's a profound difference between those two things. A promise is only as good as the institution making it. And right now, the institutions making that promise are sitting on $478 billion in unrealized losses, operating without an emergency lending facility, and quietly freezing customer withdrawals when the cash runs short. Gold does not make promises. Silver does not make promises. They do not need to. They are not liabilities. They are not IOUs. They are not digits on a screen controlled by an institution that might restrict your access tomorrow. They are real. They are tangible. They are yours. 3 banks froze withdrawals this week. The media said nothing. The regulator said nothing. And 99% of Americans have no idea it happened. But you know now. You have the data. You have the context. You have the warning. What you do with it is your choice. But the quiet investor does not ignore warning signs. The quiet investor reads them, understands them, and positions accordingly, quietly, calmly, before the crowd. I am the quiet investor. Stay calm, stay prepared, stay ahead. If this video opened your eyes to something the mainstream is hiding, subscribe and share it with someone who still trusts their bank blindly. They need to see this. I will see you in the next one.